jobs report, the 18th of July 2025. Okay, so what's in store for us? Let's see. News events. Today, I'll be sharing about the rising inflation and political pressures complicates Fed's path on rates. Now, the US inflation climbed noticeably in June, raising serious questions about the Fed's path forward as political pressure mounts from President Trump to deliver aggressive rate cuts. So a bit about the data of the inflation in June. We have seen inflation rising a bit, where the CPI rose from 2.4% in May to 2.7% in June, the largest single month increase in over a year. Core inflation, on the other hand, which excludes food and energy, also inched higher from 2.8% to 2.9%. Now, this suggests that inflationary pressures are broadening, not just confined to volatile categories. A closer look at what is driving this jump reveals several contributors. Goods affected by tariffs such as apparel and furniture saw noticeable price increases, evidence that the trade measures imposed earlier this year are now filtering through to consumers. Now, shelter costs, on the other hand, remain stubbornly high, with housing prices up 3.8% year over year, continuing to weigh heavily on household budgets. Food inflation also accelerated to 3% year over year, adding to the squeeze on consumer. Importantly, some of the largest tariffs are still scheduled to take effect on August 1st, suggesting that inflationary pressures could persist or even intensify in the months ahead. So these developments have forced markets to recalibrate expectations for Federal Reserve policy. According to the CME Fed Watch 2, the probability of a rate cut at the upcoming July 30th Federal Reserve meeting is now just 2.6%, meaning traders overwhelmingly expect the Fed to hold rates steady. Looking ahead to the September 17th meeting, expectations for rate cut also have also cooled. The probability of a quarter point cut is now approximately 56%, down from 65% before the inflation report. In essence, what was previously seen as a near certainty is now viewed as a toss-up, reflecting growing doubts that the Fed will move quickly given the fresh signs of inflation. Now, a month ago, we had a rate cut probability for September way above the 70% mark. That has reduced already. This creates that what we call, that ding dong. Like, is there going to be a cut? Is there not going to be a cut? Okay. So now it's really a toss-up. We have to wait further, and whenever it's below 70, it's not the uncertainty creeps in already. Now, obviously, we're going to have political pressure coming up from Trump, okay, and ensuing market drama. While market participants are growing cautious, President Trump has been escalating political pressure on the central bank. Trump has called publicly for an immediate 3% rate cut, arguing that inflation is very low and such cuts would save $1 trillion annually. Now, this demand comes even as inflation readings clearly show prices running above the Fed's 2% target, particularly in the core reading, which is regarded as a better gauge of underlying trends. Now, in a dramatic twist last night, a major news portal reported that Trump was actively looking to replace Fed Chair Jerome Powell as soon as possible. The report caused a sharp and sudden reaction in financial markets, with the US dollar index dropping briefly as traders worried about the implications for Fed independence. However, Trump later personally denied the report, calling it fake news, and the dollar index quickly rebounded. Nonetheless, the episode illustrates how sensitive the dollar and financial markets have become to the complex interplay between Fed policy, inflation, and political interference, right? Not only that, the bond market has also responded strongly. The yield on the 30-year US Treasury bond surged above 5% following the inflation data, reflecting reduced expectations for immediate rate cuts and increasing concerns that inflation could remain elevated in the short term. Rising yield points to higher borrowing costs throughout the economy, including mortgages and business loans, which could act as a headwind for growth. So what's the outlook for the dollar? For the US dollar, this combination of hotter than expected inflation and a Fed's perceived as more likely to hold rates steady for longer has been broadly supportive. The dollar strengthened following the inflation report and remains near recent high against many major currencies. Currency strategies generally expect this strength to persist if inflation remains elevated at the Fed and the Fed stays cautious, obviously. Such as, in summary, the June inflation data underscores that tariff, shelter costs, and the food prices are contributing to renewed price pressures, complicating the Fed's ability to deliver rate cuts even in the face of intense political pressure from the White House. So while markets have dialed back expectations for a July cut almost entirely, and now see September as a near coin flip, bond yields are rising and the US dollars remain strong. Investors will definitely be closely watching upcoming inflation releases and the Fed communication for further guidance, but for now, the outlooks suggest that rate cuts may come later and more cautiously than previously anticipated. Okay, so that's how the situation with the Fed fund rate over there, and that's causing not only that, we really need to have all this settled before I believe the market, the currency market especially settles down. You're looking at the daily charts and the weekly charts and even hourly charts. That's just only one word: volatility. Forex is already known for volatility. This just adds into it, where there is a lot of flipping to the high, flipping to the low, breaking daily high lows, weekly high lows, and just coming back to the center, up and down, up and down. Okay, so because policies like this, right, it affects countries, and the country's health is not only reflected by the stock exchange, it is also reflected in the currency. As such, for everything to stable down, we would really need the a certainty. Either it is for sure we're going to have this tariffs ongoing, or that's it, it's done. Okay, if there's always an extension and negotiations, this kind of movements will continue. Okay, so just be patient. Nothing lasts forever, and eventually things will stable down. So with that, that's the report for today.